Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And Scarlett, looks like the trade war is over for 90 days.
Yeah, we just lurch in 90-day increments, don't we?
It seems like we do. Let's get to the biggest stories right now in the more than $15 trillion global ETF industry. As we mentioned, stocks surging right now after China and the U.S. agreed to cut tariffs and de-escalate the trade war. A welcome relief for investors.
And this risk-on rally is driving many assets higher, including leveraged crypto ETFs, having the biggest returns today.
And on that note, in just a moment, Anthony Scaramucci, he is the founder of SkyBridge Capital. He'll join us to discuss why 2025 will continue to mark a major inflection point for crypto. All that and more coming up. But as always, Eric Balchunas from Bloomberg Intelligence. He's here with us now. He's looking at the flows. What do you got?
Katie, Scarlett, thank you. A little bit of a mixed bag. I would say generally pretty bullish, but I've been telling you this all year. The Vanguard bid has been relentless. VU again at the top of the leaderboard, 2.1 billion. It's now 57 billion for the year. That is about 67% beyond its record pace last year at this time. So VU just buying the market like crazy. Some bids for mortgage-backed securities here. That's kind of interesting. The Qs, the trading crowd, bought last week. They're probably happy today. IBIT, interesting. It hasn't been on the leaderboard for a while. Last year it was a mainstay. It was beta with the side of Bitcoin, remember? Where we're back to that, kind of. IBIT has gone on a run ever since the decoupling about 2.5 weeks ago. I think it's taken inflows 18, 19 days straight. LQD, TLT, some goings on in the bond area there. Let's look at the outflows, and you'll see that IVV has seen a pretty big chunky outflow. Possibly this is BlackRock's model, but certainly that would be bearish. SHV, that's short-term treasuries. That would be bullish money coming out of that. GLD money coming out. Interesting. Gold's had a better year than Bitcoin, return-wise, but IBIT now has taken in more money than GLD. Good sign for Bitcoin there. Let's look at the flows by region. You know, this whole idea of sell America, I thought it was a little overblown over the past month. I thought most people were still buying the U.S., and it's partially true. This is the flows from U.S. investors into the U.S. Last year, 90% of their money went to U.S. This year, 84%. So only a slight dip. Most people were still buying America in the U.S. In Europe, though, totally different scene. They put 50% of their money into U.S. last year. This year, 3%. So they're totally over it. Now, to their credit, they missed this run-up in the U.S., but Europe's still doing better year to date. Canada, a little dip down, so they're still mostly doing it. In Asia, they're actually buying the U.S. a little more than they did last year. So generally, this bounce back, most people probably pretty happy with it, Katie, except in Europe.
All right, Eric, thank you. Joining our conversation now, I'm pleased to say, is Cinthia Murphy. She is investment strategist over at TMX VettaFi. Cinthia, as Eric was just walking through, the flow picture has been fascinating this year. And right now, stocks are ripping. We know that could change on a dime, depending on what we hear from this White House. And given that headline risk is so high in this market, both positive and negative, what trends have you noticed when it comes to the flow traffic?
You know, I think Eric captured it perfectly when he said mixed bag. It's been a mixed bag this year. I think that the flows into your traditional core portfolio holdings have been so strong. It suggests to me, both on the fixed income and the equity side, that folks are just trying to go back to the basics. Let's figure out how to manage risk 101 and build like a good, strong portfolio that can withstand for the long term, because to your point, Katie, everything is changing on a dime. Every day is a new story, and the market can turn a 180 as quickly as we can blink. So I think that's been one big trend. Now, in the second quarter specifically, up until today, we had seen this tilt towards defensives. We've seen a lot of money go into fixed income. The conversation has been a lot about locking in that income and protecting capital. So it's been like, you know, a day doesn't make a trend, but here we are today. It's the opposite story.
Absolutely. So I want to go back to that idea of going back to basics. What does that look like, at least within equities and flows? What are you seeing?
I think, you know, the VOOs take your low cost beta is very powerful right now. Your large cap low cost beta, your traditional own the US, be bullish in the long term without frills, without whistles, and paying as little as you can for it. That's typically very core holding. In the fixed income space, we've seen a lot of that parking into cash-like instruments, which would be your SGov, your ultra short fixed income ETFs. But we have seen things like TLT, BND, FBND from Fidelity, these funds that, are just your aggregate, because folks aren't exactly sure what to do about the fixed income allocation. We just had a symposium last week at VettaFi on income investing, and it's a little bit of everything. Folks are definitely duration, nobody wants to touch it, but everything else, they're trying to find where's the place to go. So there's just that kind of, let's keep things resilient, let's keep things conservative here with an eye on the long term, because we don't know what happens tomorrow.
Cinthia, you bring up this great point, duration. We wrote a note looking at how Bill or SGov, which is 1 to 3 month treasuries, gave you just as much as the ag without the duration risk. And this is going back years at this point. Do you think we're going to see a permanent move out of the ag as the sort of staple for everybody's 40 and the 60-40 into, say, short duration stuff and or buffers?
Eric, what I think is interesting is that I think the appetite for active management within fixed income give us a clue as to the idea that maybe there's better ways to think about an aggregate type of exposure. So we've seen a lot of money go into things like the category I think of as the flexible income category. So it's these active managers that go anywhere, but they're basically aggregate portfolios that are trying to be more nimble and be savvier with duration and with credit risk and interest rate risk. I think like at VettaFi, we just acquired the Credit Suisse fixed income indices, which is also this effort to take these cues from the active management space, what's working so well, and build better benchmarks that will work for kind of the aggregate for portfolios across the board. So I think there might be a reinvention of what the ag looks like going forward because active has done so well in the fixed income space.
I gotta say, Eric, you have an axe to grind against the ag. I
do. I just think, based on what people are trying to accomplish, there's just better ways to do it with less of the baggage.
Baggage. We'll have to explore that later, but Cinthia, while we still have you, I do want to talk a little bit about launches because the product press has been really pumping this year. Eric points out that you think about the pace of launches, it's up 50% year over year. We're on pace to see 1,000 new products launched in 2025. It's been asked before, I'll ask it again, what is the saturation point here?
I would say about 1,000 ago. It's like the product launch pace. I don't know how anybody keeps up with it. I know that's our day job, but there's in my mind a lot of innovation for innovation's sake. I'm not sure a lot of products are actually solving anything for investors, but it's really an industry right now that is looking for that next thing. I think we got used to things that become your blockbuster overnight success, and folks are really trying to capture that lightning in a bottle again. So it's a lot of products, and we're not even talking about the share class approval that is probably coming, which then is going to, again, double, triple the number of ETFs in the market. So it's going to get crazy if it keeps up at this pace. But I think it's just maybe that realization. It took us 30 years maybe for a lot of folks to realize that ETFs are working. They're not going anywhere. Mutual funds are coming into the ETF space. All these narratives we've talked about for years. Maybe this is what that looks like. Now everybody wants in, and this is it. And we're just going to be looking at product launches like crazy this year.
Well, Cinthia, that's what we'll be talking about next. So thank you for the segue. That is Cinthia Murphy of TMX VettaFi. Great to spend some time with you. Now, coming up, as we mentioned, a potential regulatory shift in favor of the ETF industry expected to shake up brokers with billions of dollars at stake. We're talking share classes next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with an interesting 2 launches coming from Tidal, a white label issuer. These new ETFs pit Bitcoin against gold and vice versa. So a pair trade that lets investors bet on what they think the best alternative hedge is. Really excited to see these get off the ground. But I also want to talk about TIPS, of course, Treasury inflation-protected securities. BlackRock has been at the helm of the biggest product since it launched back in early 2000s. But now Vanguard, as you can see in blue, their TIPS product has overthrown BlackRock's product for title of biggest TIPS ETF, so a changing of the guard here. But Scarlett, I want to end with a potential regulatory shift in favor of the ETF industry. We were just discussing this with Cinthia Murphy, the idea that we could get share class approval for ETF or for issuers in general to issue ETFs as a share class of their mutual funds. As our reporting shows, this could mean a big shakeup when it comes to the business of broker-dealers.
All right, let's talk about this more with Bloomberg's Emily Grafeo, who's been writing a story on it. So, Emily, mutual funds spin off a lot of fees, and that is to the benefit of a couple of different kinds of companies. Talk us through what kinds of fees they're spinning off and who benefits from it, and therefore who stands to lose with this potential shift.
So the intermediaries in the asset management world, big wirehouses, UBS, Morgan Stanley, Merrill, and also more national and regional size. We call them like platforms, broker-dealers, basically anywhere where a financial advisor goes to purchase an ETF or mutual fund on behalf of their client. These platforms make a lot of money off of listing the mutual funds. We call it shelf space. And so if an ETF share class is added, it's not exactly clear yet how the economics are going to work out, but Cerulli estimates that there will at least be a disruption in the revenue stream because these companies do make a lot of money. They basically charge the mutual fund pays a fee to have shelf space, operational support. That fee is not really as prevalent in ETFs. ETFs trade on an exchange, so a lot of times the ETFs basically just get a free ride on these platforms, or they're not on the platforms at all. But the ETF share class was going to complicate this.
Emily, you've been covering this potential change for years now at this point, and I want to hear you weigh in on what we were just talking about with Cinthia, basically that you could see thousands of new ETFs launch as a result. A lot of interesting questions that raises about saturation in this industry. But what are the current estimates for if we do see this exemptive relief come through? What is that going to mean just in terms of product count?
So I've heard a couple people say the word thousands or hundreds, but another emerging narrative that I'm starting to hear more is that, yes, like hypothetically, we could see, just because there's over 50 asset managers currently filing for the exemptive relief, if you just add up all of the mutual funds that they have, you add an ETF share class, you're going to rack up to the hundreds and potentially the thousands. But there's so many obstacles in the way of actually getting those products to launch, one of them being distribution. If these intermediary platforms are going to lose potentially what Cerulli estimates could be $30 billion in revenue because of this, maybe they're going to not list these ETF share classes all of a sudden. So that could be potentially an obstacle to the market all of a sudden getting all of these ETFs. If you're a mutual fund manager and you're saying, I don't even think this share class is going to be accepted onto the wirehouses, why would you, quickly try and add a share class in the event of an approval from the SEC?
All right, Emily, thank you so much. Emily Grafeo of Bloomberg News. And of course, we will keep an eye on this developing story. Meantime, just ahead, as Bitcoin nears a record high, we drill down into crypto with Anthony Scaramucci of SkyBridge Capital. That is next. And a reminder that you can listen to Eric and Joel Weber on Trillions, their podcast that covers the ETF industry. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have CRPT. This is the First Trust SkyBridge Crypto Industry and Digital Economy ETF. It's one of, we call it crypto thematic ETF. It's actively managed. So SkyBridge is the one picking the stocks here. The fee is 85 bips. It's about 4 years old. It's got $100 million. The idea here is, hey, let's look for crypto companies that get a majority of the revenue from the crypto industry. It also has some of the ETFs in there. Let me show you the holdings here. You're going to see some of the obvious names at the top here, MicroStrategy, Coinbase, Galaxy. But look, you got iBit in there. There's the Fidelity Bitcoin ETF. So they kind of spread the love between the Bitcoin ETFs. I believe about a quarter of it is in straight Bitcoin. The rest are in these stocks. Obviously, they've had a nice run. Let's look at the performance of this. I threw in one of its peers, which is BitQ. This is the 2-year returns. So CRPT is up 55%, BitQ up 45%. The whole group's doing pretty well, though. But look how much the performance is over SPY. I mean, this is 2 years. Obviously, there's been some ups and downs since, but that's pretty strong. But Bitcoin, better than all of them. But this for the stock market, again, this is a stock trade versus SPY there. So no wonder this area is getting some flows, Katie. It'll continue to get looks if it puts up performance like this.
Eric, thank you. And joining us now to talk about this ETF, I'm thrilled to say we have Anthony Scaramucci. He is the founder of SkyBridge Capital, joining us on set. Great to see you in person.
I mean, Eric, I mean, I was almost as good as my mother writing the thing. I mean, that was really good.
He does his homework, and we have a lot of questions for you about the crypto industry at large, but we are going to start with this product because, as Eric described it, this is sort of a thematic crypto ETF that tracks equities, and you do have a lot of these sort of products out there that say that they track the digital asset ecosystem and that are also actively managed. So how do you differentiate this product from the rest of the field?
Well, first of all, thank you guys for having me, and I appreciate being here. I would just say to you that this was born from a non-Bitcoin exchange-traded fund world. So remember, this is 4 years ago. We're trying to get our clients access to something that correlates with Bitcoin. I would make the case that there are still clients out there, particularly at these wirehouses, that are having a hard time getting approval on Bitcoin still to this day. And so the case for this is a good surrogate. If you want to be in Bitcoin, certainly go out and buy Bitcoin. If you can buy the Bitcoin shares, whether it's the Fidelity ones or Galaxy Invesco or the BlackRock one, certainly would recommend that. But if you can't do that and you want some exposure to the ecosystem, and you want some exposure to great companies inside the ecosystem, I think we have the best story to tell and arguably the best performance, if you don't mind me saying that, just based on the metrics that Bloomberg is showing.
In looking at the holdings, you have 2 U.S. companies as the biggest holdings, MicroStrategy and Coinbase. But then you've got Galaxy Digital, which is listed in Toronto, and MetaPlanet, which trades in Japan. So you now have currency exposure as well. Why go this route?
Well, because again, the MetaPlanet is sort of a pure play in Bitcoin. And so even though we have modest currency exposure, we like that. I guess if you look at that list, I think the thing that our investment managers are saying at SkyBridge, what's going to get us the most correlation to Bitcoin without taking on too much exogenous risk? So the currency and the sizing of that is not overly consequential to us. As it relates to Galaxy, I think you know this, Galaxy is about to list on the NASDAQ, and so I think that'll be helpful there. But we're big fans of Mike Novogratz, worked with Mike at Goldman 30 years ago, and like that company overall. So the brokerage component of this, I think, does help. Right? Coinbase and Galaxy are companies that we think are highway systems in the world of digital assets. And so it's not just a pure play on the assets themselves. You're getting a little pickup on the infrastructure.
Let's talk a little bit about the future and where Bitcoin's going. I was on stage with Robbie Mitchnick in Dubai. He said when the decoupling happened, that day where Bitcoin went up and the stocks went down, there was a couple days like that, was major. He got calls from some big fish, and they were like, finally, it's acting like gold. How important is Bitcoin to behave a little better and not be a high beta stock for it to really go to the next level with corporations, governments, and institutions?
Well, I think that's it, Eric. Ultimately, what we see is the evolution of Bitcoin from being sort of a tech asset tied to the Mag 7 or tied to the NASDAQ to something that's more akin to digital gold. And as that starts to happen, and I predict that will happen as wallets expand. Let's say there's roughly 300 million or so wallets for Bitcoin right now. Imagine a world where there's 1 billion wallets, 1 billion holders. The volatility should dampen. That happened in Microsoft. That happened in things like Google over a 20-year period of time. And so you could see a scenario where more wallets, lots of institutions in the mix, long-term holders, dampening volatility, and then you have this positive flywheel where the volatility is dampened by long-term holders who are owning it in size, and so therefore that reinforces the idea that other long-term holders should come in. I guess the big thing you have to ask yourself, is Bitcoin an investment or is it an asset class? If it's an investment, then $1 to $3 trillion, that sort of makes sense. That's akin to a Mag 7 market capitalization. But if it's an asset class, then it should trade to closer to where gold is. And I think gold's, I don't know, $22, $23 trillion right now.
I do want to bring in politics and regulation to this conversation because there's stablecoin legislation working its way through Congress right now. And I want to hear your thoughts on why that potentially is important and whether or not that should include restrictions on the Trump family and the administration broadly.
Well, I don't know if you can restrict one family, and so I don't know what the laws are, even if that's allowable in the Constitution. But I think what we have to do is we've got to get stablecoin legislation through because it'll help the digital asset space. It'll help the United States maintain its mantle of financial leadership, financial services leadership. But I think the other thing stablecoins do, just a reminder to people, whether it's Circle or Tether, they own a ton of U.S. Treasuries. I think Tether now owns more U.S. Treasuries than Germany and Japan. And I think we want to have this legislation provide great clarity, regulatory specificity, so that we've got a lot of players in the mix. Eventually, banks can get into the mix, and eventually I could hold my Bitcoin at a bank. As it relates to the Trump family, I guess what I would say, my message to the Trump family would be, be transparent. If you're not doing anything wrong, I'll accept on faith that you're not doing anything wrong, but be transparent because we're in a partisan tribal environment and you got to let people know exactly what you're doing. Otherwise, people are going to assume the worst.
Right. There are a lot of people, some in the industry, who are concerned that the First Family's involvement in crypto is a way to just make money. What is your level of confidence that this administration, both at the executive and regulatory level, is serious about supporting the build-out of the U.S. crypto industry?
Well, I think it's very serious. I think this is the thing. A lot of the what I would call the crypto bros, if you will. There's probably women in there, but let's call them crypto bros. I think they moved into fair shake and they gave a lot of money to Republicans or some Democrats that are supportive. And I think in the beginning, I would say it was skeptical and probably politically driven. But I think as people learn the story, they recognize that this is going to be a large component to the future of finance. And so I do think it's serious today. Was it serious in July of last year when they spoke at the Bitcoin conference? Probably not. It was probably political, but I think it's serious today.
Okay, 45 seconds. You obviously are into Bitcoin. Any of the altcoins excite you? We're going to see ETFs for XRP, Solana, Ether. People are going to have a lot of choice. What do you think about those?
Well, I would focus on Solana for right now because you have an ETF out there. It's SolQ, S-O-L-Q. Those guys at 3IQ were the first to launch a Bitcoin ETF in North America, the first Canadian ETF. We own a lot of Solana, just full disclosure. And again, full disclosure, we at SkyBridge are investors in SolQ because we like that exposure. We also like the staking component to Solana, which you think is very good. So it's just a great way to get in there. Those other ones are going to be good, Avalanche, Polkadot, et cetera. But Solana.
All right, got to leave it there. Really appreciate you taking the time. That is Anthony Scaramucci of SkyBridge Capital. You can read about this drill down plus the latest in the ETF industry when you subscribe to my weekly ETF IQ newsletter. But that does it for us. This is Bloomberg.